What's up, YouTube? It's the Money Man here, and today we're talking about options contracts, or how to lose all your money in the drop of a hat. Option contracts are amazing, incredible, extremely powerful, super dangerous things, and it's one of the biggest reasons why personal finance guys and other individual investors don't want to talk to you about it. So, an options contract or a call or a put is literally just a piece of paper saying, I agree to give you the right to buy 100 shares of whatever ETF, bond, or stock that we have underlying on a specific date for a specific price. So, for example, I could give you an options contract based off of Apple. You come to me and say, I want to buy 100 shares of Apple, but I don't want to pay for them all right now. But the price it's going for right now is, $140. That's exactly how much I want to pay for it, but I want to pay for it 2 months from now. I say, okay, sure, we'll agree upon the date, and we're going to say you have the right to buy it at $140 between now and 2 months from now. There's something called the strike price. That's the $140 that we're talking about with Apple. The actual price that you pay for the contract, the option, is whatever the market or whatever you and me say it is. So I can tell you that for this $140 strike price of Apple, you're going to have to pay me, I don't know, $1.40 for every share that you want the right to. So therefore my asking price is $1.40. But it's $1.40 for every single share in our options contract. So that makes the total of worth of this contract $140. Now this is pretty agreeable to you. You think, yeah, I think Apple's going to go up in the next 2 months way more than that. So you buy the contract. Because you think it's going to go up, you and me agreed upon is what we call a call. You want to buy the shares in the future. You're saying that Apple is going to go up. Therefore, you bought a call. Now, if you think that the price of the underlying asset, the stock or the bond or the ETF, whatever, is going to go down, then of course you want to short it. But I sold you a call. The other option is a put, and the put is the right to short the underlying asset. In this case, you think Apple is going to fall, it's old technology, it's an awful company, whatever. I agree to give you the right to short Apple between now and whatever date again we pick in the future. It's the exact same structure. The only difference is that with a put, it's the negative difference. With a call, it's the positive difference. Okay? So that means if you thought Apple was going to crash and go to $1, right? We have the same contract, only this time I think Apple's a little bit more likely to go down. So my asking price is going to be a little bit different. So I'm going to tell you that, all right, I kind of agree with you, Apple's going to go down. So I'm going to charge you $2.40 for every share that you want to short. You still think that this is awesome because you think Apple's going to $0. So you say, sure, I agree to buy it. Again, transaction's done. That's it. This is the only difference between a call and a put. It's up and down. Remember, call up, put down. These options contracts do trade on the market. But unlike the actual underlying asset, they're not just directly correlated to it. That means if Apple does go up $1 in a day, your call contract might still wind up being worth less. You think, how the hell is that possible? Well, for starters, news might have come out about Apple that they're going to be losing money in the future. But over the short term, they just had a big sale or whatever. So the stock price went up over a day, but in the long term, it's going to drop. So even though the stock went up, your options contract went down. This can be kind of frustrating as a derivatives trader because you have to keep track of not just of the underlying asset, but of everything that could happen to it between now and the expiration of the contract. The bright side is at any point with this contract, you can get out of it. You can sell it as long as there's another buyer on the open market. So the price of that contract, though, is going to be dictated by the market. This is why there's so many people talking about derivatives being so weird and frustrating It's because you're buying leverage and then you're offering leverage with a different date and different time from what you bought it. Traditionally, what happens is the closer you get to the expiration date of the contract or our agreed upon date from which the contract will be finished by, the less it is worth. Now, it's going to be worth more, obviously, if the asset is moved in whatever direction it is that you wanted it to move in. However, because the time frame decreases, the options contract is going to be worth less because there's less time for positive and for negative things to happen with the underlying asset. That being all said, this is without a doubt the best leverage you can get currently on the open market. You can also buy ETFs that are already leveraged, doubling, tripling your actual leverage. This can lead to some high-risk bets, a lot of big money, and also losing your entire bank account. That's it, guys, for today. I hope that kind of sums up options contracts for you. If you have any questions, please ask below or shoot me an email. Subscribe if you like this video. If not, dislike it. I don't care. Just give me some feedback. Thanks. Have a good one. And as always, guys, watch what you're doing with your money.